So we proceed in the second video with introduction to company accounts. We move to bonus issues. A bonus issue is when a company wishes to increase its share capital without raising additional finance by issuing new shares. Now, why would a company want to increase the share capital without raising additional finance? The company may have projects which needs financing, but instead of paying out the dividends to the shareholders and then going back to the shareholders and asking them for more money to invest, the company may decide to use the retained earnings to reinvest. And since the shareholders will have been expecting dividends, so not to upset the shareholders by not giving them dividends, the company would instead offer them more shares so that in future when the company does pay out dividends, the shareholders will receive more dividends. However, the fact that there is no additional cash coming in, the funding of these bonus issues should still come from somewhere. So the funding of the bonus issues will come from the share premium account. So it will just be a book value movement from share premium to share capital account. So before we look at the calculations, let's look at the advantages. So the first advantage is that the bonus issue can be made from the share premium account, which has few other uses. The second advantage is that it will allow the share price to fall without disadvantaging the shareholders' wealth. When you issue shares to outsiders, what happens is that the shareholding ratios for the original shareholders are reduced. So when you issue through a bonus issue, the shareholders' percentage is maintained, it's not affected. Lastly, advantage is that the shareholders will now own more shares. If they so wish, they could sell part of their holdings, or in future, as we have said before, they'll be able to receive more dividends when the company declares dividends. The disadvantage is only one. The rationale for a bonus issue is not always understood by shareholders. So, how do you account for this bonus issue? Bonus issues are always issued using the nominal value or the par value. So we continue with our earlier example. You recall that we had started with 50,000 worth of shares. Then we had a new issue of 100,000 shares, which brought our share capital to 150,000. At that point, we also introduced a share premium of 60,000. We now have retained earnings since we've been operating for a number of years. So our total equity is now 410,000. Equity is a combination of share capital and retained earnings. Now, Rabco wants to make a bonus issue of 1 for 4 shares held. Now this calculation, you need to be comfortable with it from the word go. You will meet this 1 for 4, 1 for 2, 2 for 5 a lot of times. That, in this case, the 1 for 4, you use it not on the value of the shares, but on the shares. Now, in this question, we've got 50 cents ordinary shared, valued at 150,000. In between here, there's an invisible figure which the examiner tends to hide. Sometimes they'll show it to you, which is the number of shares. So to determine what this invisible figure here is, you divide 150 divided by 50 cents. That gives you the invisible number here, which is the number of the ordinary shares. So that's the one that we use. So 150 divided by 5 gives us 300. The 300, we divide it by 4, then we multiply it by 1. So you always divide it with the figure on the right first, then multiply with the figure on the left. If it was 2 for 4, we'll divide by 4 and then multiply by 1. In this case, it's 2 for 1, so we'll divide by 4 and multiply by 1. Then we multiply that by the par value or the nominal value, which is the 50 cents there. Since we've said bonus issues are all the time issued at par value, to give us 37,500. So the number of shares will increase by 300,000 divided by 4. 75,000 shares, new shares, will be issued as a result of the bonus. This valued at 37,500. So we'll do a book entry. The share premium account will be debited or reduced by 37,500. The share capital account will be increased or credited by 37,500. So below here, you now see the new capital structure. The share capital initially was 150, now it's 187,500. The share premium initially was 60,000, now is 22,500. The retained earnings remains the same. The total equity remains the same. So the total equity in a bonus issue does not change. Again, there's no cash movement in a bonus issue. Remember, when you see the word bonus, it means shares issued for free. Because when you come to computing the cash flow statements, the examiner likes testing you on bonuses there. You have to remember that in a bonus issue, there is no cash movement. So when you find such a question in the statement of cash flow, you just ignore it. Ignoring in the sense that there's no cash movement. There's another way a company may issue shares, which is known as a rights issue. A rights issue is when a company issues more shares to the existing shareholders, but these shares are issued at a discount. So they are issued at a discount to entice the shareholders to subscribe to these shares, because maybe the shareholders may not be willing to put in more money into the business, but the business may have these other investments which they need to finance. So instead of going to the market and raising more money from the market, which would end up diluting the shareholders' shareholding, the management may decide just to go to the shareholders and offer them rights issues. So a rights issue are shares issued to existing shareholders at a discount. What are the advantages of rights issues? It's a more cost-effective way for the company to raise finance than a fresh issue to the public. A fresh issue to the public requires a lot of paperwork, requires a lot of disclosures, and can also be quite costly as compared to a rights issue. A rights issue is more time efficient, does not take long to raise funds as compared to a public issue. And finally, if all the shares, the shareholders take up their rights, then the shareholders will maintain their existing percentage shareholding. But even those shareholders who may not want to take up the rights, they can still take up the rights and sell those rights too. So they can sell those rights so that they receive cash. The disadvantage is that if there's a lack of shareholders' interest in taking up these rights issues, it may reflect badly on the company, that their own shareholders don't seem to have any confidence in the affairs of that company. The other advantage is that it may encourage unwelcome predators who may acquire these shares from those shareholders who do not take up their rights. And lastly, the last disadvantage is that the effect on future dividend policy, as company will have issued more shares under a rights issue than it would have under a fresh issue from the public. Now, what does that mean? These shares which have been issued, they are not bringing in the market value in terms of cash coming in of those shares. So their contribution to the company will not be at market value. But if the company had gone to the market to raise more funds by issuing more shares, the same number of shares, the company would have received much more resources which could have been used to reinvest into the business. We continue with the same example we've been looking at for Rapco, but this time the company makes a rights issue of 1/5. The price of the rights issue is 150, and we assume that all the shareholders, they take up their rights. The company has now been operating for a number of years. Like we said before, the share capital will remain the same until there's a new issue. So the book value of the share capital is 187,500. From our previous question, the share premium is 22,500. The company has made more profits now. More profits have been transferred from the income statement. Remember, our retained earnings in the previous period were 200. We've had new transfers. The retained earnings are now 230 to increase our equity to 440. So how do we account for this rights issue? 145, again we said you apply it on the number of shares, not the value of shares. We now have 375,000 shares, so you divide that by 5. So we are increasing our shares, so 375 divided by 5, we're increasing our shares by 75,000. So our shares will now be 450,000, which is 735 plus 75. The rights issue of 150 is broken down into the nominal of 50 cents or the par value of 50 cents and the share premium of 1. So 75 times 50 will give us 37,500, and 75 times 1 will give us 75. So 112,500 cash will come in, which will be debited to the cash account, and the share capital will increase by the 37,500, and the share premium equally increased by the 75,000. So that concludes issues of share capital. Those are the ways in which your share capital or your equity will change in a financial year. We continue with the rest of the study in the third video.